Margin Trading Explained, a beginner's guide. Welcome back, future goats and whales. Today, we are unpacking something that can supercharge your trading or trip you up if you're not careful. Margin trading. Ever wondered how people trade more stock than they can afford? That's margin. It's borrowing money to play bigger. We'll cover how it works, the perks, and the pitfalls, like those dreaded margin calls. By the end, you will know if margin is your friend or foe. Ready to level up your trading know-how? Let's get started. How margin trading works. So, what is margin trading? It's when you borrow cash from your broker to buy more stocks or other assets than you could with just your own money. Think of it like a loan for investing, but with a twist. The stocks you buy are the collateral. It is a way to amplify your moves without needing a fat wallet up front. Here's how it goes. Say you have $5,000 in your brokerage account, and you want to buy Apple stock, trading at $200 a share. Normally, that's 25 shares, $5,000 worth. But with margin, your broker might let you borrow another $5,000, doubling your buying power to $10,000. Now you snag 50 shares. You still have your $5,000, but the other half is a loan. The rules come from two places, the government and your broker. In the U.S., the Federal Reserve sets a baseline. Usually, you can borrow up to 50% of the purchase price, called the initial margin. So, for $10,000 of stock, you need $5,000 of your own cash. Brokers might tweak this, and some offer more leverage, but that's the gist. You'll pay interest on the loan, maybe 5 to 10% a year, kind of like a credit card, but it's baked into the deal. If Apple climbs to $220, your 50 shares are worth $11,000. Sell, pay back the $5,000 loan plus, say, $50 interest, and you've got $5,950 left. Almost $1,000 profit. Without margin, 25 shares at $220 is $5,500, just $500 profit. Margin doubled your gain with the same $5,000. That's the magic. It juices up your returns when you're right. Benefits of margin trading. Now, why bother with margin? The benefits can be pretty sweet. First, there's leverage. That power to control more with less. Your $5,000 turning into $10,000 of Apple stock? That's 2-to-1 leverage. If the stock jumps 10%, you're not just up $500, you're up $1,000, minus interest. It's like a megaphone for your gains, perfect for traders who spot winners and want to go big. Second, it's flexible. You can use margin for stocks, ETFs, even options or futures in some accounts. Day traders love it. Buy $10,000 of stock in the morning, sell by afternoon, and pay back the loan same day. No interest piling up. It's a quick hit tool for fast markets. Plus, you don't need to wait for cash to settle. Margin keeps you in the game. Third, it's a portfolio booster. Got a hunch Apple's about to pop but don't want to sell other holdings? Borrow on margin, grab more shares, and ride the wave. If you're confident, it's a way to stretch your capital without liquidating. And in a bull market, when stocks are climbing, margin can feel like a cheat code, turning small wins into big ones. Brokers make it easy too. Apps like Robinhood or Interactive Brokers offer margin accounts with a click. You just need enough cash or assets to qualify, usually $2,000 minimum, and you're off. It's not free money, but it's a shortcut to bigger plays. Potential pitfalls and margin calls. Here's the catch. Margin trading has a dark side. The biggest pitfall? Losses get amplified as well. Back to Apple. The price drops from $200 to $180. Your 50 shares are now worth $9,000. After you pay back the $5,000 loan, plus the $50 in interest, you are now left with $3,950 from $5,000. That's a $1,050 loss, over 20%, when a $200 drop on 25 shares would have been just $500, or 10%. Margin doubles the pain when you're wrong. Then there's the interest. That 5 to 10% adds up. Hold a losing position too long, and it's like pouring salt on the wound. Unlike a regular loan, brokers can yank the rug out with a margin call. Here's how. Your account has a maintenance margin, usually 25 to 30% of the total value. For $10,000 of stock, you need $2,500 to $3,000 in equity. Your money, not the loan. If Apple falls to $160, your 50 shares are $8,000. Subtract the $5,000 loan, and your equity's $3,000, safe so far. But at $140, it's $7,000 total, $2,000 equity, below the line. The broker calls, add cash or sell stock now. That's a margin call. You've got hours or days to fix it. Deposit more money or dump shares, maybe at a loss. If you don't, they'll sell for you. No questions asked. Worst case? A market crash wipes your equity, and you owe more than you have. It is rare, but it has happened. Margin is a loan with teeth. Volatility is the enemy. A steady stock is safer than a roller coaster. Well, guys and gals, that is margin trading explained. Recap. It's borrowing to trade bigger, great for boosting gains with leverage, flexibility, and portfolio power. But losses hit harder, interest bites, and margin calls can force your hand. It's a turbocharger, not a toy. Use it smart, or it will burn you. Test it out with a paper or demo account first. Real stakes need real caution. What do you think? Tempted to try margin? Thank you for hanging in there until the end of this video. Don't forget to subscribe to the channel and give this video a like. See you next time.